Hi, this is Suzanne Docobo back again, Realtor CPA. Today I want to talk to you about the different tax classifications when you own rental real estate. Most people don't understand the differences and they can significantly affect your tax situation. The three different types are passive, active, and real estate professional. But let's start by explaining what passive income and passive losses are. Generally, if you have a rental property and your rental income exceed your expenses, you're gonna have what's called a passive income, and that's gonna be taxable. However, if you have expenses that exceed your rents, you're gonna have a passive loss. So this all comes into play in how passive losses are treated. For example, most passive losses by default are only deductible against passive income. Let me give you a real world example that might make it just easier for you to understand. I know this can be a really complicated subject and nobody really is a fan of the Internal Revenue Code. So let me break it down in an easy to understand manner. Let's say you own a rental property and your rents for the year are $50,000. Then you also have expenses, depreciation, mortgage interest, real estate taxes, etc. And your expenses equal $90,000. In this scenario, you have a $40,000 passive loss. Now, under general rules, under the Internal Revenue Code, you will have that $40,000 loss and you cannot take that deduction this year. It will roll over to future years and then you can offset it against future passive income. However, you cannot take any deduction in this year for those passive losses. Now, there are exceptions to this rule and I want to point them out. Even if you do day-to-day tasks and even if you are involved in the rental property, this doesn't mean that you meet these scenarios. There are very specific guidelines and let's dive right into each one of them. Now we're going to talk about the second classification, which is active participation in a rental real estate property. That's when you own 10% or more of the property and you also actively participate, which can mean approving tenants, approving repairs, stuff like that. So that's what will make you qualify as an active participation. In that scenario, there is an exclusion where you can deduct up to $25,000 of your passive losses against your income. In this scenario, there is, to be noted, phase-out limitations. If you make over $100,000 to $150,000 a year, it starts phasing out. So there are limitations where you won't be able to get to the deduction. But if you meet that criteria, you could deduct up to $25,000 against your other income. So in the same example as before, if you had a rental property with $50,000 of rents and then you have $90,000 in expenses, you'd be able to deduct up to $25,000 of that rental loss against any other ordinary income that you have. So obviously you have to have the income to offset the deduction, but you would be able to deduct up to $25,000, and if you have the income, then the other $15,000 would roll forward and carry forward to future years where you can deduct those later on. The third and final and best classification you can possibly attain is what is called by the Internal Revenue Service a real estate professional. To qualify as a real estate professional, it's very specific. You have to spend more than 50% of all your work activities in real estate work. And so that would be managing your properties, but it can also be a realtor, a broker, property manager. It could even be a real estate attorney that specializes in that type of work. So as long as you spend more than 50% of your time and more than 750 hours annually working in real estate, you can qualify as a real estate professional. Why is this so advantageous? Because in this scenario, there are no limitations to what you can deduct against your other income. So there's no phase outs, there's no limitations. So in our example, if you had $50,000 in rents and then $90,000 in expenses, you could deduct the entire $40,000 against your active income if you have other income from other sources. You have to meet the criteria, but if you do, it's really, really great. You do need to make sure you can document this if the IRS ever questioned it, but it's a really good thing to know, and I realize that a lot of people just don't understand the differences between these classifications. So educate yourself, make sure you know which classification you fall into, and then you could plan better for your taxes and just have a better strategy throughout the year. So one other thing that's great is that you can also avoid net investment income tax, which is 3.8% if you qualify as a real estate professional on your rental income. So that's actually also another benefit that I want to document. Final takeaway, I want to also mention that interest income is actually classified as portfolio or ordinary income, so that doesn't classify as passive income. It's something that people don't really understand. So really it's just rental properties or other type of things that you don't material participate, interest is excluded from that. So it matters to know what classification you're going to fall into for tax purposes for your rental properties, because you might be doing a cost segregation analysis, or you might be doing accelerated depreciation, and you don't really want to, you lose the losses. Of course, you want to try to take advantage of the losses. Consult with your CPA, make sure you understand and they understand what classification you're supposed to be in, and not just put you in the default classification. Because if you qualify for active participation or real estate professional, there's thousands and thousands of dollars in tax savings that you can gain on that. If you have any questions, please leave them in the comments below, or you can reach out to us directly. We're always here to help, and we'll see you next time.